Hi, this is Bob Meindl from Mathworks, and thank you for joining us for a really timely session on portfolio optimization across risk, returns, and climate. We will be starting in a few minutes. I just want to remind you to please ask questions in the Q&A. If we have time at the end, we will answer as many as we can, and if not, we'll be glad to follow up. And with that, I'd like to turn it over to Riley LeFrancois.
Thanks, Bob. This is Riley LeFrancois. I'm a financial services account manager here at Mathworks. And thanks, everyone, for joining us. And like Bob said, this is a very timely session, as you've been hearing a lot about climate risk in the news lately. So we'll have our lead financial engineer, Marshall Alfonso, presenting on that today. As Bob mentioned, please feel free to populate any questions in the Q&A, and we'll do our best to get to those. If not, we'll be happy to follow up with you afterwards and spend a bit more time on those. We'll also be forwarding out the slide deck after too, so you can have that for reference. Without any further delay, though, I'll hand things over to Marshall and we'll get started. Thank you.
Thanks, Riley. Thanks. Welcome, everyone, to a very interesting session. So from a logistics standpoint, we're going to be doing about an hour or so on the. There's going to be a lot of material in this presentation. And so to kick things off, I'm actually going to turn off my video and we're going to keep going from here. Bob, quick sound check. Can you guys hear me?
You're good.
Loud and clear.
Excellent. All right. Welcome, everyone, to Portfolio Optimization Across Risk, Returns, and Climate. As everyone knows, this is a very sort of important topic that's hitting all our financial institutions today. And so I'm actually capturing a quote that you're seeing up here. It says, if I translate that, this basically talks about the future, and I'm going to start with the translation here. This came out of the United Nations Special Report that basically says it's not merely important to foresee the future, but to actually bring it about. And you're going to see why this is relevant as we go through the talk. So let's start with the basic agenda. What is climate change and why should I care? Now, what is climate change? I'm going to basically help you understand it through the lens of finance. So you might see some sort of climate change physiology. I'm kind of mixing in two different fields here, but the geophysics of what's going on in the world is going to be relevant to us understanding how we can infuse that data into our thinking. So the simplest definition, and this is sort of like my summarization of the definition, is it's a change in the temperature of the Earth with significant financial ramifications. And how the financial ramifications actually come about can take different forms, and you'll see that as well. So to start with, if you think about the world and you think about sort of our ozone layer and everything, and this is not meant to tell you what the science is, I'm just kind of like stating what we understand. Solar energy sort of comes in and it bounces out of the atmosphere normally. If you have some molecules such as carbon dioxide, nitrous oxide, methane, and other hydrofluorocarbons, then what ends up happening is the solar energy bounces around inside and heats up the Earth. This is a natural process within the Earth. But what ends up happening is if you end up building up any of the core greenhouse gases, GHGs, carbon dioxide, methane, et cetera, that's when you start seeing heating up. That's when you start seeing physical risks that are impacting a variety of things such as floods and forest fires and things like that in South America. And that's when you will have to start thinking about the financial ramifications of it. So let's use this information to actually understand what this looks like through the lens of the central banks. Now, there is a specific bank group called NGFs. NGFS is a membership organization which consists of 95 central banks and 15 observers. So you can see here, you're welcome to go through this page. There's a lot of banks over here, and I've had the privilege to go out there and meet a lot of them in person pre-COVID and understand how they kind of look at the world. Now, let's take a look at the models that they've built. And I've built a little application here, and you'll notice it's actually sitting inside a web page. I built an application in MATLAB to help us look at the data. And we're going to start with a very simple question that a central bank may think about, and you may be thinking about when it comes to how does climate change impact my portfolio? So the first question is, do different integrated assessment models, which are the models that the central banks are producing, are they all in agreement? Do they produce the same sort of results? And let's look specifically at a very popular macroeconomic measure when it comes to climate change, which is GDP, which is sort of the productivity of the world, and other macroeconomic variables. And you can see there's different models out there. There's GCAN, Image, and we'll come back to sort of these models themselves, and we'll touch on why and how to kind of interpret these models. But for now, let's look at a baseline scenario. So according to baseline scenario of a forecast of GDP over 100 years, so you can see there's 100 years here. So it's over 100 years, all the models seem to sort of agree that there's an upward transition expected to happen in Europe. What about the United States? In the United States, they're all more, there's a lot more agreement on that. The European one might be, due to Brexit and sort of the long-term ramifications of that. Maybe that's a bit too short-term, but think about sort of how Europe's going to evolve. Latin America, you can see occurring right here. But look at a reference policy, which is sort of moderately regulated world. Then you see that the GDP is still sort of going up, and there's a little bit of disagreement in terms of the models themselves. USA and Europe, just to kind of give you a feel for things. So with regards to GDP, there doesn't seem to be much difference whether you're using a baseline policy or reference policy. And what happens if we go to a stringent policy, and you can see there's not much of a change either. Where we start to see changes is in the area of forecasting greenhouse gases. And those could have physical ramifications to, for example, the Chicago Mercantile Exchange, if you're dealing with futures contracts, where you're dealing with oil contracts on the exchange. So if you had a baseline policy, a lot of the models are a little bit, they're all over the place, especially for, let's take carbon dioxide. Carbon dioxide, you can see the models, this remind model right here, it says it goes up, but then it comes down. The actual amount of emissions of carbon dioxide goes down. Methane is a little bit all over the place. What happens if you switch over to a reference policy? You can start to see that all the models start to appear to go down. What about a stringent policy? They all indicate that over 100 years, we're able to reduce our overall greenhouse gases. Now, this is a very simple example, just to kind of give you a feel for some of the data that we're going to be working with as we start to think about the ramifications of climate change. So why should you care? I'm showcasing some data. I think you should care because climate regulation, maybe climate change may not be directly impacting you today, but climate regulation is percolating through our economy. And that's a very important consideration when you start looking at how should you tilt your portfolios to basically account for the climate regulation that might be coming your way. Let's actually take a step back, and I was thinking about how do we frame the challenges around this problem. And one way of doing it is I've actually taken inspiration from Sisma, which is the Securities Industry and Financial Markets Association. And you'll notice this is their roadmap that they put together, where today, I'm just highlighting a few things here. What they're saying is we're in a stage of unclear taxonomies regarding climate data. Data is limited and not congruent, inconsistent standards, which makes it very challenging. If you're familiar with sort of working with market data, we know that one of the biggest challenges we have in doing any kind of modeling is getting our data under control. And we're in that phase right now from 2021 to 2023. We're expecting there to be sector transition pathways, well-aligned definitions in the taxonomies, and data set standardization across companies. And so that's when we can start to take advantage of it. And I like to kind of think of that next phase after 2023 as sort of the optimization phase. Data is now easily available. We have a variety of products. A lot of the industry is finalized in terms of their mergers and acquisitions, in terms of bringing it on board the right partners for their organization. And they're really trying to optimize to compete as financial institutions. So what are the business questions that we're going to be dealing with here? The first one I saw a little bit of is the data itself. What climate models are relevant? And a lot of these questions came about from discussions I've been having over the last few years with a variety of different financial institutions. What climate models are relevant to my portfolio? How do we translate the climate data into discount factors to discount sort of risks in future cash flows? In the portfolio construction area, one of the questions that's very common is how do I tilt my portfolios to account for climate risks? What are the right optimization algorithms? How will my portfolio evolve with climate policy? Stress testing is obviously a very important consideration. What are the right climate scenarios to look at? What's the right way to systematically think about shocks to our portfolio? And explainability and governance is always key to helping us get our models through production. What I'm going to focus on is just these three questions right here, is what climate models are relevant to my portfolio, and how do we tilt our portfolio, the optimization problem, the climate data problem and the optimization problem. And from the mathematics perspective, the optimization problem is a very challenging problem. And the way I've seen a lot of people approach it, they're kind of approaching it with brute force, but that's a very costly affair, especially when you start scaling up into the cloud. So let's actually frame the problem, the mathematics of the optimization problem for a second. So how do we think about tilting our portfolios accounting for climate data? So when we start thinking about mandates, there's a lot of incentive structures built into our mandated benchmarks at the top level of our portfolios. So that I think of as sort of fund level, asset level mandates. There's portfolio level. So once you aggregate all the different portfolios together across the different onshore, offshore accounts, the different currency accounts, you end up with sort of attribution benchmarks that are relevant for incentivizing through tracking error, incentivizing the portfolios to move or tilt the portfolio a certain way. And then finally, at the security level, you might think of concentration limits when you start to look at how things kind of flow that way. Let's actually take a look at a demonstration here, just to understand what this could potentially look like. And what I've built is I've built a little dashboard right here that allows me to optimize my portfolio. So I'm actually going to open up a little application. And this is a high portfolio optimization problem. Now, this is meant to set the stage on how to start thinking about infusing in some of the climate data that we saw early on in our portfolios themselves. So what you see on the top over here is a whole series of bonds. These are bonds out of the Merrill Lynch High Yield Index, and so you can see there's a lot of these bonds available for me to choose from. There's zero weights on all of them. One of the strategies that is very common in the industry is a replication strategy. Whoops, I'm meant to open a slightly different one here. Let me open up the ESG one, ESG flavored version of this. Okay, so this is actually running on my cloud right now. This is my Amazon cloud infrastructure, so I have enough compute power up there to run this. So what we have here is all of the different ticker symbols, ALI, et cetera. We have some sort of ESG scores associated with these different tickers, Bank of America, et cetera. The question is, can I choose high yield bonds that basically replicate these different characteristics, yield to worst, spread to worst, and modified duration to worst? And in this case, I'm actually going to use a very simple, I built this demo quite a few years ago, actually, but I'm going to give you a flavor for things by infusing in sort of like the ESG scores. Without giving you all the details right now, we'll come back to how we actually use that. So what this did was it took the high yield bonds and actually allocated a certain percentage, 2.5% to ALI, bank, RBS, et cetera. And so you can see here, this is the portfolio that's been selected out of all my bond portfolios, and you can see that the portfolio itself is replicating the high yield index over here with a yield to worst that matches up, a spread to worst that's matching up, and a modified duration, the worst that's matching up. Now, from a climate perspective, there's a variety of scenarios that you can stress test this portfolio or the expected future cash flows by discounting things such as interest rates and looking at how the cash flows are impacted by that. And so you can see that the actual cash flows are being impacted by incorporating in some of the climate factors that are going to be relevant to us going into the future. One other thing you could do is then look at attribution. That's a very important thing, is like the mandate level is what's really driving these returns, and you could always look at the returns themselves and try to get a sense of what's going on, or look at the VAR numbers as well. So I put that into the portfolio. So I can see here there's a minus 3.8% loss, and you can start thinking about how does my climate portfolio itself get impacted by the actual climate factors themselves. Now, the business of optimization is quite complicated. It's one of the biggest challenges with optimization is we overfit to the past all the time. The explanation, how do you communicate with governance teams, is quite challenging. We work very closely with some of our tier 1 partners, tier 1 bank partners, to help them take their optimization models in climate and help them get that through governance. And what ends up happening is a lot of groups kind of arbitrarily, for example, use FMINCON or some sort of choice of optimizer. And what ends up happening once you start scaling the problem is a lot of wasted compute cycles. The other challenge with doing that is you don't end up with necessarily a global minimum. You end up with sort of like a localized minimum depending on your initial start point. Forecasting is impossible. Long-term predictions are extremely unwieldy. So how do you start incorporating those into your optimization problem? So one of the problems that we've dealt with over the last few years is with asset managers, in which you have a variety of different portfolios, and they want to kind of optimize against a benchmark. So as opposed to the traditional benchmarking model, which is like the Fama-French style model, maybe you can incorporate in some sort of ESG factors, and then you're trying to minimize the optimization problem against some sort of like objective function, such as tracking error, Sharpe ratio, volatility, information ratio, et cetera, subject to a variety of constraints. And this constraint landscape gets very complicated very quickly. And you're going to get a glimpse into that today. So it's easy enough to get your models through governance, but one of the challenges I see is when you're starting to use it and retrain those models, that's when things get complicated, because the governance team always asks the question, where are your parameters coming from? Did you really truly converge? How are you making sure you're not overfitting to history? How are you infusing climate data? Those are really challenging problems, and those are the kind of things that we're going to look at in terms of how we begin to approach this problem. All right. So let's take a step back now. We saw a few demos already, but what I'd like to do is actually take a step back and look at the climate framework itself that's being put out there. And you'll see this percolating through a lot of our presentations that are coming from the industry, whether you're talking to consultancies or whether you're looking at internal groups. A lot of them use very similar structure. I think of it in two big buckets. There are physical risks and there are transition risks. The physical risks you can think of as you're going to the doctor and you have chronic pain, stuff that's sort of systematically percolating through your body. Oh, my back is hurting or something's hurting. You can think of the earth in a similar way. You can think of chronic pains as like the sea levels are rising, but it's not a direct impact to our financial institutions. On the acute side, you can think of floods, hurricanes, direct impacts as sort of other risk factors that are harder to model, but the insurance industry has been doing it for years. Another big area are the transition and policy risks, is how are governments going to react to regulating our industry? And so how do we start thinking about incorporating those risks into our portfolio construction problems? So one popular thing that's being done is we're taking a lot of this information. So we're doing taking a lot of the transition pathways, the integrated assessment models, which is what I showed you early on, infusing it into macro impact type models, along with the chronic climate problems and the acute. One of the areas that the central banks and a variety of other groups are struggling to infuse into, or the institutions are struggling to infuse into portfolios, is this acute problem. What's happening in the short term is very hard. They're like black swan events. They're very hard to incorporate in. This is stuff that's a little easier to kind of incorporate. This is stuff that has a lot of assumptions and are also available for incorporation into your models. So to frame the portfolio optimization problem, let's think about the question of how do we infuse this climate data to achieve our risk and return targets. And the talk that I started with was what's the right way to optimize our portfolios given risk, returns, and climate. And the way I found to help at least frame the problem is I like to think about it in two time frames. The right question is, am I tilting my portfolio in the short term, or am I tilting my portfolio sort of in the longer term? And you need both. You need tactical asset allocation as well as sort of strategic asset allocation that's happening at different levels, whether it's macroeconomic type factor tilts or at an asset level factor tilt. You need both of them, and that's pretty common with a lot of portfolio management today. So let's start with the transition pathways, and I'm going to give you a flavor for the transition pathways themselves. We saw a little bit of the, let me actually pull that up here. Let me pull up my climate change data model. So with the NGFs climate data, this is all of the different central banks. And we got a glimpse into two questions I asked originally as to how do integrated models, do they agree with each other? How do they forecast? But there's a lot more data available for us to play with. And I'm going to give you a little glimpse into that here. So what you see over here is the actual NGFS database. So there's a lot of data available for us to look at. And let's start by just looking at all the different models available. So in this example right here, or in this database, I can see there's a Which, TIAM, Remind, et cetera, a variety of models available for us to choose from. They're what are known as integrated assessment models. And it's important to kind of understand that each of those models are infused with different types of scenarios. And there's a variety of different scenarios, but the ones I'm going to kind of reference are these three right here. There's a baseline scenario. There's a reference policy scenario in which sort of like moderately regulated environment, and then a stringent regulated environment, and how it's going to impact our different variables over the next 100 years. So in this case, let's look at one model right here. So this is AIM end use CH4, so methane gas. Methane is heavier, more dense than carbon dioxide, CO2. And so this actually traps more greenhouse gas in more of the atmosphere, raising our temperature more, but we have less of this in the environment. But this is actually a large producer of methane gas is agricultural farming industry. So let's look at Asia and CH4. So if I look at CH4, so you can see according to this limits 450, which is the 450 parts per million of carbon dioxide limitations, according to the regulations, is going to actually have a positive impact in the sense that we're going to reduce our CH4 over 2050. This is how much data is available over here. Let's look at a baseline policy. And so if I look at the baseline policy without any regulations, we can see that CH4 is going to actually increase over here. What about carbon dioxide? And so carbon dioxide is also doing something very, very similar according to this database right here. But we can take a look at, let's take a look at the United States. And so you can see here the United States is also increasing. and you can take a look at a variety of different scenarios. You can look at the reference policy scenario and get a sense for how that's going to impact your actual climate change portfolios. Okay, so the data, once you start getting familiar with sort of baseline, the regulated environment or stringently regulated environments, and start to get a sense of what data you're dealing with, those really help us get a handle on the next problem that we're going to be dealing with, which is forecasting out key financial indicators such as GDP. So in this case, what happens with GDP, let's take a look here under our reference policy, sort of moderately regulated environments. It's still going to go up as expected, so that's good. So GDP is not going to go down. I think we as a society are probably going to, adapt, but we're not sure how the physical transition risks are going to impact our overall ability to move forward. To give you a glimpse into the data that's feeding these models, let's think about what these integrated assessment models do and how they're built. And a lot of them are built in a very similar way. They are macroeconomic models that try to capture, for example, a variety of different dynamics, GDP, population, policies, and other assumptions, with traditional sort of economic outcomes as expected. So for example, if I looked at GDP, you can think of GDP as a function of sort of like the cost of doing business, the imports, the exports, all the traditional productivity metrics that you can expect. Now you can expect on sort of if you look at population, let's take actually a specific model here. So there's a variety of models that couple together human and sort of physical systems, earth systems, to explore economic environmental policies. Let's look at one of the models, which is a model that integrates a unified framework, bringing in the elements. I think it's the easiest one to explain. So let me look at that. Yeah, here you go. The which model basically takes a very simplistic idea of population growth. If you can predict population growth, so if you go back in history, there was about 2 million people, went to 20 million, 200 million people, and then you're talking about billions of people that sort of exist. It turns out we can, they use that as part of this, the which model to forecast out utilization of resources and how we're draining sort of the different resources that are critical to our energy production industries. The model then kind of balances out as a dynamic equation, a set of dynamic equations that are then solved to basically produce the actual forecast that we see today. Now, let's actually see if we can use MATLAB to actually kind of build our own versions of these models for GDP, okay? So this is one of the first challenges that you have, is taking the climate data, the transition risk data, and mapping it to actual financial impact data that you're going to be able to utilize as part of your portfolio. So in this simple example right here, we have, I'm going to run a hypothetical stress testing tool. And this tool right now is built to take in a fixed income portfolio and stress it out. So let's start thinking about the mapping of the climate data to the actual our portfolios themselves. And there's a variety of ways to do it, and I'm going to show you the first way, which is using simple ways of discounting our future cash flows. These are all corporate bonds. And if you had to do a very simple stress test, I could value and stress this portfolio after doing a fit. So I fit my corporate, my yields right here with a Nelson Siegel type fit. I'm able to use a parallel shift over here, stress out my portfolio. There's about 10,000 bonds over here. And I revalue, so just using the pricing functionality out of our financial instruments toolbox. I revalued my portfolio and resulting in about $271,000 for the cost of this portfolio, had I bought one of all my instruments. With a a shift in the yield curve in a positive direction, my overall portfolio, because of the maturity dates right here, would lose 6%. Okay, so that's the baseline. We're starting with a very simple sort of parallel shift. But let's actually think about sort of a climate stress. And so let's think about stressing out this portfolio. And so when we start thinking about stressing out the portfolio, yeah, there you go. So what we see here is when we think about a traditional stress, the yield at different points along the term structure might move by a little bit, typically beta adjusted by some sort of like relationship that we capture through something like a covariance structure. So in this case, for example, had I moved my 5-year yield a little bit, everything else readjusts. And you can ask the question, how would that impact this portfolio? Let me move that a little bit. That was a slight shift here. You have lost about 6.8% because this is about a 1% shift, kind of very similar to what I had done before. What happens if I switch to a baseline climate stress scenario? And so you can see here, everything is adjusted. And in this case, given the regulated environment, this is a very hotly debated topic. I had a chance to, before speaking to you, I actually had a chance to speak to some of the economists out of some of the hedge funds that we're dealing with and try to get a sense on what their thinking is around interest rates. And that's a good question for you, is how are the policy risks in the short term going to be balanced out by sort of the physical transition risks, which we're seeing in the news today, and also the social media risk of the news articles going to impact the regulated interest rate environment? How is the government going to respond? Are they going to lower, are they going to raise interest rates to counterbalance the different economic forces that are going on? In this case, a simple baseline scenario infusing in some of the climate data you saw earlier resulted in a 2% loss in my portfolio. Had I chosen a moderately regulated environment, stressed out my portfolio, it turned out we actually had a gain. Obviously, this portfolio is custom to what's actually within the walls of this portfolio. I could also look at a stringently regulated environment, and you can see here the yields are going down, and the losses are going to go up. Sorry, the gains are going to go up here. In this case, positive gain on my portfolio. Now, what's actually happening under the hood is important. And this is what I want to spend some time on here, is when we start thinking about the mapping of financial impacts, it's important to kind of think about the different ways of forecasting out these transition risks, because now we're not looking at the past, we're looking at the future, and we're how do we infuse future scenarios into our climate portfolios? And so if I had to invest $100 today, how is $100 going to be impacted by hurricanes that are hitting us, or sea levels rising, or temperatures basically affecting emerging markets in a certain way? Then we need to kind of break it out into forecasting and nowcasting. And I'm actually stealing the word nowcast from meteorology. So meteorology has this concept of short-term forecasting, something that we would look at in the short term. Forecasting, on the other hand, is sort of that macro or long-term forecast. And the other group that stole the meteorological term is the Federal Reserve. They actually have a nowcast model that we built out in MATLAB as well, and you can look up the nowcast code that's available in MATLAB, and it's available online. Let's start with a long-term forecast, and I'm going to take a little bit of a journey into the forecasting problem itself to take account of a variety of the different macroeconomic variables and start to think about how do you forecast that as an input into our optimizer. Now, this is a little bit of a very new, it's hot off the press. It's a really new model that we built. It's not even in MATLAB yet. So I'm going to give you a glimpse into it, and I'm sure if there's any questions, please feel free to reach out to us, and we're happy to have a deeper dive into the modeling itself and the forecasting itself. Now, when we started this talk, we started with a black box model in the sense that we're using pre-built models that the central banks are producing. In this example, I'm actually using the MATLAB econometrics functionality. So out of the box, this is one of the great things about MATLAB is you have a lot of pre-built functionality. In this case, I'm using the econometrics toolbox with all their pre-built multivariate vector autoregressive models, Markov switching models that are really, really powerful when you start to do any kind of modeling. And I think there's different ways to kind of think about it, but let's start with looking at the data available to us. This is just U.S. Treasury yield curve data between 1972 and December 2000. So in addition to it, I have 3 macroeconomic factors that are all going to be impacted by climate change. In this case, CU represents the manufacturing capacity utilization, FFR represents the federal funds rate, and the PI represents the price inflation. And so the question for us is, how would climate change impact our manufacturing capacity utilization? And talking to some of the economists, they're like, oh, that's a silly question. It's a cyclical factor. I'm not expecting any kind of impact. And so what they do care about, though, is GDP. They definitely care about sort of the impact of climate change on GDP, which is a measure of our productivity at a corporate level, at a sector level, at a national level, at a global level. But for now, just to illustrate the concept right here, I'm going to give you a sense of how to start thinking about these in the context of a climate stress scenario. And you can think of, if I did stress out these things, you can think of basically stressing this out by shifting it a basis point up or down once you have a pre-built model or once you have a trained model. The first model I'm going to start with is an autoregressive model that kind of forecasts out what your yield curves are going to look like. Now, the model I'm going to use here is a model which basically forecasts out yields, decomposing yields in terms of 3 components, the level, the slope, and the curvature of the model. Now, notice there's a little t over here on each of those parameters. So this is level, this is slope, and this is curvature. So as opposed to assuming it's a one-time estimation regression process with lambda as well, there's a lambda term in here. It's not just a one-time estimation process. You can actually think of it as a function of time. So you're actually estimating through an autoregressive process how the level, the slope, and the curvature are going to actually shift. Without getting into the details of the math, which we're happy to do with you, is let's actually go ahead and fit the vector autoregressive model here. And so you can see here, we're doing it 2 separate ways. This is the first way, which is the blue line right here, which is a 2-step process. Essentially does a simple regression and just basically loops through all the different slices of the yield curve to actually estimate what the level, slope, and curvature looks like. You can see, let me actually expand this out here. What you can see here is the vector autoregressive process itself. Oops. Now, what you see over here is a vector autoregressive estimate on the parameters. So you can see the betas themselves are about the same for both the models. It might be slightly off on this or slightly different on the state space model versus the vector autoregressive model. Now, the state space model is a very powerful model, though. The simple regression model is good for sort of like a starting point. The reason I personally like the state space model is because of the fact that you can now infuse the ability to forecast and predict the future. And so what we did then is we took the state space model and we augmented that with macroeconomic factors. So the 3 factors that I mentioned, the manufacturing capacity utilization. And so you can see now that the vector autoregressive and state space are the same, but the macro enhanced one basically accounts, this is just showing you the 3 adjustments on the level, slope, and curvature, but you end up with basically the ability to forecast out the future by infusing in macroeconomics into your model. Now, how is this related to climate change? I have two models that we built in MATLAB. So the first thing I'm going to do is forecast out my yield. And according to the macro-infused model, if I zoom into the end right here, oops. If I zoom into the end, you can see that the macro-infused model appears to be going up. Let me zoom out again. There you go. It seems to be going up. And that's basically telling me that this is our expectations on the yields themselves. They're going to go up. Now, when you start thinking about the mapping of the yield with the climate data, you can expect that when you slice and dice it, the yield forecasts are going to basically produce a variety of different sort of scenarios, beta adjusting your yields themselves. So this is the yield curve. And so the question is, how do you actually forecast out those or stress test the yield curve? Well, that's exactly what we did early on, is with the climate stress scenarios, you can take that yield curve as a stress scenario and then stress out your yield curve to produce what your expectations are on your portfolio itself. Okay. So this is a little bit of a glimpse into sort of the forecasting piece of it. Now let's actually take a different stab here, and this is, I wanted to spend some time on this, but I think I'm going to skip this example just in the interest of time, is we do have the ability to forecast out, and we have some very powerful functionality with deep learning that you can basically forecast out GDP, infusing in the climate variables to be able to do the carbon pricing adjustments, the expectations on your interest rates, et cetera. That might be worth discussing. We also have an econometrics app that's very powerful. So let's actually take a look at sort of the second piece, which is the nowcasting piece. And in this case right here, another way to look at it is not just sort of a discount curve for infusing in climate change, is we can think about ESG, because it's very popular in the industry now, is infusing and identifying ESG scores, like I showed you in the beginning, can be used to tilt the portfolio one way or another. So in that example, let's actually pull that up here. Actually, I have it over here. I'm just going to pull it up on my simple ESG example here. Oh, actually, I'm going to pull it up in MATLAB. So in this simple example right here, it's actually giving you a glimpse into our optimizer. And I was trying to find a way to give you a way of understanding ESG scores. Now, to help us, what I did, which you're going to find quite exciting, is in the ESG area, there is an organization called Science-Based Targets. And Science-Based Targets goes through and basically, it's an organization that basically takes companies and look at which companies are taking action to actually target a specific classification. So you can see here, these all the different, and there's 169 pages of companies available for us. Some of them are committed to taking climate action. Some of them actually specify target classifications well below 2 degrees Celsius. And you can actually drill into the details here on the viewing the targets. All I did was I pulled all the data in. I constructed an ESG score based on the actual climate policies themselves and the expectations, along with generating an ESG rating. So some of them are highly rated, some of them are not as highly rated. So this is just a random portfolio of a handful of them randomly picked out from the bucket. So you can see here, if I click on Rand Portfolio, it's actually going to randomly pick different portfolios. I could then click Optimize, and what I'm going to do now is for those 340 different portfolios, I'm going to optimize the frontier. Now, it takes a few seconds to do this because this is actually a 340 by 340 covariance structure, but what you end up having here is the actual ESG rated efficient frontier sorry, not ESG rated. This is actually does not account for any of the ESG ratings. This is our baseline efficient frontier. Now, what you could do is tilt the portfolio based on, by starting off with a benchmark portfolio. So in this case, I'm going to actually generate a Sharpe ratio portfolio along the frontier, and it's actually going to construct, based on the ESG scores themselves, an ESG calculated portfolio with basically the Sharpe ratio portfolio as my benchmark. And you can see here how much of an emphasis there is on, with the Sharpe ratio optimized portfolio. You can see that this is just straight up Sharpe ratio optimization. It's not accounting for the ESG scores at this stage. You can see that there's quite a bit of the C and Ds in terms of our benchmark portfolio itself. If you click on optimize, what this is actually doing now is going to tilt our portfolios. I'm going to give you a glimpse into the optimization in a second of what's going on behind the scenes. But what it's actually doing is it's constructing portfolios by optimizing our portfolio against our target portfolio. Our target portfolio is saying, let's try to optimize the results by targeting a specific weight set that we actually end up having here. And so you can see here, there's a sharp tip off as the ESG scores get to a certain point. The trade-off between sort of the tracking error, the deviation from the benchmark portfolio, has a significant upward propagation as very significantly deviating from our portfolio itself. In addition, when we start looking at sort of the return trade-off, you can see there is a trade-off right here, and this has to do with the diversification benefits that are actually occurring in the way we look at the ESG scores infused into our portfolio itself. You could look at a variety of different portfolios and start to look at the actual ratings themselves. So I could look at the rate, whoops, I didn't mean to click it again, but you could look at the portfolios themselves and get a sense of where do I want to operate my tilt to get a sense of what is the right portfolio blend for me. Now, we've seen a lot of material in terms of modeling the portfolio, and we got a little glimpse into the optimization platform itself. But I'd like to actually give you the power to do this yourself. And it's actually, we have some great infrastructure that's been built and expanded on that really make it very easy to be able to do portfolio optimization. So when we start thinking about infusing in our weights on the portfolio themselves, there's several mathematical formulations out there that allow you to optimize your portfolio to kind of meet your needs. But within MATLAB itself, I want to show you a very powerful example that gives you a sense of how to build your own version of optimization. So this is a starting point right here. You define what is known as the objective function itself. It's a very simple objective function, but I'm going to give you a very powerful tool. So this is a three-dimensional optimization problem with three components: x1 minus pi squared, x2 minus exp of 1 squared, x3 of 5.2 squared, with a starting point of 0, 0, 0. What we have now is the ability to create a live task. So I can basically click on optimize, choosing a live task of optimize, and now we have the ability to very easily optimize this portfolio to meet our needs. So all you have to do is specify, this is going to be a nonlinear. Let's choose an unconstrained just to make things simple. We can choose F-min constraint unconstrained. We can choose let's see here, I need to actually run, let's put this into, yeah. to run this piece right here. So let's create the function itself, and we're going to actually choose our function handle that we just created and choose x0 as a starting point. I'm going to choose a current function. I'm going to display the iterations, and I'm going to choose maybe display the objective function. So let's run this piece of code. Oops. Okay, and so what it's doing right now is actually optimizing the it's actually running the optimizer. It was animated, but there was only 3 points because it actually converged fairly quickly to sort of the optimal value of minus 5.2 pi, which is about 3, and 2.7, which is exp of 1. So you have this very powerful capability with the live script and the live tasks to really jumpstart your optimization. But if you're really looking to think about the future and thinking about how would you do this yourself, we have done this in collaboration with other clients. So just reach out. But taken our existing infrastructure, which infrastructure, all you have to do is create a portfolio object itself, asset means, and you have an object to start with, set the solver, and you're ready to go. But what we've done essentially is extended the object to allow for custom objective handles. Now, this is done on a custom basis. It's not part of our core infrastructure, but because of the fact that we work very closely with our tier 1 banks, we're able to do this for them. And what you end up with here is 3 separate optimization examples, taking advantage of our newest infrastructure, which is our problem-based infrastructure, which is actually very easy to use to end up with the 3 different efficient frontiers. So when you start thinking about your optimization problem, don't be limited to FMIN/Con. Start to look at the problem-based optimization setup, which is very easy to use here to get your optimization workflows up and running. It's as easy as basically running and setting up the problem. Right from the documentation, you can basically set up the variables for the problem. You can set up the objective function here. Oops, let me set up F over here somewhere. Either way, it's quite easy to set up this problem and actually run through this workflow itself. And you can actually just open up a live script and run through our example to be able to do this. Okay. All right. Our optimization capabilities are quite extensive. I think when I look at the way people implement things with the FMIN/Con and some of the basic optimizers, I feel like there's a lot more opportunity to really tilt your portfolios and end up with those global optimals that tilt your portfolios based on the climate factors that are being infused into your thinking. Another important example that's in our documentation is the Longterm, which I'm seeing a lot of papers out there coming out that through a Bayesian type infrastructure able to tilt the portfolios to really sort of meet your needs. And so I would highly recommend you take a look at that. Now, where do you go from here? So I started at the beginning with the securities industry and financial markets example or vision that they had. They basically said, we're in the phase of nascent and growing in which the data is a bit of a challenge. So if you have challenges with data, let us help you. We have a lot of different expertise, all the way from, if you look at the original roots of our company, we have a lot of expertise in the geophysics area. I've had an opportunity to work in the geophysics area for a variety of different problems myself, and we've been using deep learning for those problems for over 20 years. So if you have problems with that climate data, come to us. We are happy to help. In the optimization area, glimpse into the optimization capabilities we have here. We have some very powerful capabilities that I feel are being underutilized by the industry, but we do have a significant amount of expertise in that area. In addition to that, what is Mathworks doing? Well, we're actually going out there and actually making a difference in trying to understand climate change ourselves. We're developing deep partnerships with our organizations like MIT. So we're actually part of their group right now in terms of partnering with them to try and figure out what are the right climate models. And what we are doing on the finance team is trying to figure out what are the right climate models and how do we infuse those into your climate change portfolios. So to kind of finally end here, we've covered a lot of ground. We've seen a glimpse into the data, a glimpse into the climate models and the amazing capabilities of being able to build fairly sophisticated forecasting models using state space and Kalman type approaches. You got to see the ability of our functionality to be able to tilt your portfolios to exactly in the direction that may help your portfolios take advantage of these different climate effects. Even if you're not a believer in climate change or the climate models, regulation is percolating through the economy, and we're here to help. So if you have questions, feel free to reach out. Let us know how we can help. I believe there's a lot of powerful functionality within MATLAB itself that's being underutilized, and we're doing a lot to really help you get your models all the way from sort of its inception all the way to production. And feel free to reach out, and I'm going to take a minute here and see if there's any questions that came in on the chat.
Thanks very much, Marshall. This is Riley again. While Marshall's checking out to see if there's any questions, just wanted to put a little plug in for our Computational Finance Conference, which will be next month, September 27th through the 30th. It'll be about 4 half-day sessions focusing on everything from portfolio optimization to AI, data science, climate risk, model risk management, etc. So keep an eye out for the invite for that, and we hope to see you there. And I'll hand it back to Marshall if there are any questions.
Perfect. Thank you. It looks like there's quite a few questions that have come in here. What I'd start with, there was one of the questions that come up, and I'll end with this as well, just because in the interest of time, and we are happy to get back with you later. How do you come up with the ESG scores? That is the million-dollar question. Everyone's looking around to try and figure out how do we come up with the ESG scores themselves. Some papers out there are indicating that you have to look at the structural dynamics of a company to be able to tilt their corporate abilities to meet their policy implementations. There was a recent Harvard Business Review that basically said a lot of the ESG scores shouldn't be trusted. So if you have questions specifically about construction of the ESG scores, the way I constructed it was basically a simple support vector machine to kind of incorporate in some of the financial stability data and tilt to produce the scores that we're seeing over here. So with that, thanks to everyone for attending. Looking forward to answering your questions and helping with your climate questions that you may have going forward.
Thanks very much, Marshall. And we will send out the slide deck. And like Marshall said, if there are questions or you have interest in taking a deeper dive, we're happy to do so. So we'll be in touch, and thank you all for your time. Appreciate it. Have a great day.
Thanks, everyone.